Now some business news. Sean Pellegrin's joining us here on set. We're going to start in China today. The stock market's reacting positively to the government sending signals it will lend more support to the struggling economy there, Sean.
That's right, Stuart. Let's start by looking at how the major stock markets in Asia have been trading this Tuesday. Investors feeling upbeat about Beijing providing support to a sluggish recovery. The Hang Seng in Hong Kong and the Shanghai Composite, as you can see there on the mainland, trading up with the Hang Seng up almost 4%, the Shanghai Composite just over the 2% mark. And looking at specifics, tech stocks and property stocks have been posting the biggest gains. Real estate groups, Long4 and Country Garden, both surging this Wednesday. You can see Country Garden's stock going up 25%, while Long4's same for the Long4 stock there on the Hang Seng in Hong Kong. On the tech side, the general gauge for the tech sector on the Hang Seng has gone up 5%. Some key performers are electric vehicle makers like NIO and XPeng. They're both posting big gains there. XPeng over 10% and the NIO just under 10% at 9.25%.
It follows a meeting from the Chinese Communist Party's top decision-making body on Monday, doesn't it?
That's right. The July Politburo meeting, which was chaired by Xi Jinping, is often seen as setting the tone for the second half of the year in terms of economic policies. The official readout from that meeting set the stage by admitting that the economic recovery that has taken place after the government suddenly reversed course on its zero-COVID policy in late 2022 has not been as dynamic as hoped. It said, as you can see there, after the stable transition of epidemic prevention and control, the economic recovery is a process of wave-like development and tortuous progress. To help this tortuous progress along, well, the Politburo wants to focus on a laundry list of targeted efforts which have been described by analysts as just coming short of large-scale stimulus. These includes more support for the troubled real estate sector, which crashed in August 2020 because of its enormous debt load. This sector could represent as much as a quarter of China's gross domestic product. There's also a pledge to boost domestic consumption, which has fallen short of expectations after the economy opened up again. And one other big point is to resolve the issue of local government debt, which has ballooned in part because the property slump has reduced a local government income.
Oh dear, all rather tortuous. Give us a sense then, Charles, of just how disappointing China's recovery has been.
Well, the official target for growth in 2023 is 5%, and the government is still holding on to that target. For most countries, that's a huge level of growth, but it's slow by Chinese standards. The government says this is normal. The economy is transitioning away from the rapid growth rates that started in the early 90s and says now it is focusing more on what it calls quality growth, more in line with that of fully developed first world economies. But the other indicators there are a real cause of concern, especially the youth unemployment level, which reached in June a new record, 21.3% jobless rate for people between 16 and 24. New graduates are struggling to find positions that meet their qualifications, and that could lead to dissatisfaction, which could lead to social instability, which is one of Beijing's biggest fears. Stable employment has been elevated as a, quote, strategic goal at that July Politburo meeting on Monday.
Sean, thanks very much. Sean Pellegrin with the business news.